Hey everybody, thanks for joining this video. My name is Chris Harris, a certified financial planner, and today we're going to be talking about a tax strategy that can be very beneficial for business owners, and that is the Augusta Rule. So maybe you've heard of this before, maybe you currently use it, or maybe don't understand how it works. Well, we're going to dive into that today. Hopefully, make it easier for you to understand so that you can talk to your CPA and see if you qualify to use this in your own tax planning. So as a disclaimer, before we dive in, this video is for informational and educational purposes only and should not be considered tax, legal, or investment advice. Okay, so let's dive into the Augusta Rule. So what is the Augusta Rule? We'll start off there. We'll also talk about who can use it, how does it work, some common mistakes that we see, and then also potential tax savings. Again, this is one of those things where you really want to work with the CPA that knows kind of your tax situation very well, and they can help you set this up correctly. There are a lot of nuances, and you want to be very careful on how you set it up and document, and we're going to get to that in a minute. But I can't stress enough how important it is to work with a qualified CPA. So what is the Augusta Rule? So the Augusta Rule actually came to be because in Augusta, Georgia, that's where they hold the Masters, and there were a lot of people that would rent their house out to, folks that were coming to see the Masters, and it was only for a short period of time, and it was only during one time of the year. So it wasn't this whole like, hey, I'm going to set up an Airbnb type of situation or even a long-term rental, but it was only just seriously for, a short period of time. We're talking a few days to a week or so. And so it was handed down in Congress, and there was a section created, the IRS Section 280AG. This is the tax code for the Augusta Rule that says that you can rent out your space, your house, for up to 14 days, and you don't have to include that as rental income, in terms of your income. So it's actually kind of a nice deal there. And we're going to talk and focus more so on the business side of it and how businesses can use it. So with that being said, who can use the Augusta Rule? So there are certain entity types that can use it. So S Corps can use it, S Corps, C Corps, C Corps, and partnerships. Partnerships. Okay. Those who cannot use it are like sole proprietors. You have single member. That was terrible. Single member LLCs. If you just have Schedule C income, so you have to be, so these guys you cannot use it, and these guys you can. So, LLCs, if your tax is an S Corp or just LLCs in general, C Corps, S Corps, those are all good. If you're just a sole proprietor, single member LLC, or LLC tax as a sole proprietor, you cannot use you don't qualify for the Augusta Rule. So how does this work? So what you can do is, as a business, so let's just say you have an S Corp. Okay, you have an S Corp. You also have a home. Okay, so this is your home. But you also have an S Corp. Well, your S Corp can actually use your home for meetings. That would be like presentations. Strategic planning. So these type of meetings, your S Corp can use your home for those meetings, and your home can say, hey, I want you to pay rent for those 14 days, okay? Up to 14 days. So the S Corp can pay your home, whatever that is, whatever you're going to charge them, I guess I don't need more than one arrow, they're going to pay them rent to use your home for these meetings. Okay. And that's really the power of the Augusta Rule, because now your S Corp gets a business deduction, and then your home, so it flows through to your personal, you don't have to pay any taxes. So no income taxes on the rent that you received. Okay. So that's really where it becomes powerful, because you get that deduction as a business expense for how much you rented it out for that period of time. Again, you want to make sure that you stay within that 14-day period, and this has to be legitimate business. Okay. So again, if you have meetings, things like that, strategic planning, and so that becomes very, obviously important as to why you're using it. Also, kind of going back to who can use it, you think about this as, I would think like professional services. So like professional services, so like attorneys, real estate, investors, I promise my handwriting is not this bad. It's just this pen is really small, and so it's hard to write on this pad. Real estate investors. We have consultants. So if you kind of think about anything or small businesses that you have, these planning meetings or strategic meetings, anything like that, would probably qualify as somebody that it would make sense to use. Okay. If you house a restaurant, maybe, if you're like, hey, we don't want to meet at the restaurant, we're going to rent our house out and maybe do some parties or, business planning meetings, that would be something that could potentially work. Again, this is really where you want to work with your CPA to see what they feel comfortable with as well. So 3 important rules. So rule number 1 is we want to stay under 15 days. If you do not, that is a big deal. Okay. So you want to stay under 15 days. You don't want to, extend this thing to 30 days and then deduct all the 30 days. That's going to cause problems with the IRS, and, maybe trigger an audit. So we have rule number 2 is charge fair market rent. Do not go crazy with this. If you charge over this, and you need to document this, if you charge more than the fair market value or the fair market rent, so you want to definitely look at comps and make sure that you're not charging a erroneous amount. Again, that can trigger audits. So you want to be fair with what you're using, or what you're renting out your house for. And then you need legitimate business purposes. So this isn't something where you want to, mess around and try to, pull a fast one on the government. This is definitely one where you want to have legitimate business purpose, right? Again, maybe it's kind of having a strategic planning meeting. You have all your employees meet at your house, and you're renting that out for, you have, again, meetings, or kind of maybe a strategic retreat where you have this big conference kind of deal at your house for so many days out of the year, right? So something that becomes legitimate, that your house really will be needed for that business purpose. Common mistakes that we see. So common mistakes are going to be, like we said, charging too much. So charging too much. Okay. It doesn't mean that you can't charge a lot, right? It's got to be comparable to what other rents are going for that specific thing. If you can go and get a rent, you can rent out, a conference room at a building for significantly cheaper, then that could cause some issues. So you want to, again, be very comparable to the fair market rent rates. So charging too much, failure to document. So that's a big one. You're not documenting, meeting agenda, meeting minutes, who attends. We'll talk about that in a minute, but that's definitely something that you make sure you want to do. Exceeding 14, we talked about this one already. Exceeding 14 days. Again, we don't want to do that. And then no legit business. If you don't have legitimate business, it's not going to work, right? Like, you want to make sure that you do that. Otherwise, if you're just trying to, again, pull a fast one, it could, not be too good for you. So these are some big mistakes. I think this one's really a big one. Obviously, they all are big, but failure to document is your first problem. If you're not doing that, that's an issue. And then there is one more I want to put here is no paper trail. And that kind of ties into this one here. But you want to document and you want to have a paper trail of, again, the rent, whether it's checks, things like that. How does that all, tie in to make sure that it's a legitimate transaction? So as we talk about this, I'll put this up here, but some of the things that you want to do. So these are things to do. We want to do meeting minutes. What was done at the meeting, right? Having meeting notes is going to be huge. Who spoke, what was about, that type of thing. That's going to be very important to have. You're also going to want to have an attendance. Attendant. Oh my gosh. I apologize, but we are struggling with the pen today. So attendance. Okay. Who was there? Who attended the meeting? Make sure you have a list of people, employees, business, partners, whatever. We want a calendar. Kind of a calendar trail. So what date? So when, where, that type of thing. Obviously, we know where if it was your home, but just so it's all documented, right? And then you want evidence of, let me get rid of that. Evidence of fair market value rents. So you definitely want to maybe have that in a documented area where it's, you see other rents, the same kind of square footage or kind of, in the same location range. Make sure you have that evidence. And then you want to have some agreement. So a rental agreement. Okay. So you want some sort of an agreement between you, the business, making sure that, hey, this was actually a real transaction. We have proof of payment as well in part of that. So that'd be proof of payment. Proof of payment. Those are also, like I said, pretty important things to have as you do your documentation. This should all be in a folder. Make sure that you have this really tightened up for potential audit, things like that. So, and that's definitely something that you want to do. Again, not looking back. So, you come to tax time, you tell your CPA, hey, I want to use the Augusta rule. Well, this is nice to have if you can just go take this to your CPA and say, hey, we have this all done, documented. This is how much it was. And then let your CPA go to work, as opposed to, going to your CPA. Oh yeah, we did this, conference at our house. And we want to use the Augusta rule. Well, we're going to need to do all this, document it. At least you should, just to be prudent. But that really, kicks it off, I think, right in terms of tax season, and hopefully not, have your CPA pull their hair out. So, okay, so that is what we want to do. So now let's talk about Augusta Rule scenario. So this is a scenario. Again, this is just a sample client. And so these numbers are fictitious, and there's a lot of little nuances that may not be correct. So, but the idea behind it, I think, shows you how you can use the Augusta Rule. So if you look at this column here, this is just a tax planning software. But this is right here. So this is without the Augusta Rule. Okay, this first scenario, and we can see here, this is going to show our Schedule E income right here. And what we've done is we've taken this scenario, so this is our current scenario, and we've actually compared it to a scenario using the Augusta Rule. Okay, so with this individual, we had Schedule E income of $200,000 right here. We used $20,000, so we had a $20,000 deduction from using the Augusta Rule. So what we did here is we just said, there's a little worksheet here that we did. We said we're going to have $20,000 in income, but there was a deduction there. So that's going to reduce our Schedule E income by $20,000. So this is that red takeaway here. So we're going to be down to 180. And as we can see now, our total income gets reduced, right? So we go from this 283 to 263. Again, this is going to flow through into your 1040, but if you can see the taxes, so QBI, we have QBI right here, so we're going to have a reduction here. And then also, if you look at our tax situation, we are actually going to reduce our tax liability, okay? And so, and it also depends. So our total tax just went from 39 to 32. Okay, so 39.1 to about 32.5. So that's $6,634 that we essentially saved. Okay. And so if we look at our ordinary income, so our marginal tax bracket, so this person's at the 24%. And so you can see that, I don't know why that 24%, but you can see that as you say you're in the 30%, 32% tax bracket, this becomes even more and more, a bigger savings, if you will. So it's one of those things where it can become very powerful if you use it correctly. If you document, it can actually save real tax dollars, because again, you're getting the deduction on the business side. It's not flowing through you as rental income, so there's no personal tax on it. And so it's kind of a nice deal there where your business will get the business expense, and you don't have to pay taxes on it, right? And so again, it's just really important to make sure you set it up correctly, but this is a legit tax strategy that a lot of business owners use. Again, if you fit inside of that mold of if you qualify to use it, and if you're using it for business, legitimate business purposes, then it becomes a very powerful tax planning tool. Hopefully this helps. Hopefully this makes sense. Didn't want to make it too complex, but just give you the idea behind how folks are using this Augusta Rule to lower their tax liability. Hopefully, again, that helps. That gives you some clarity, and we will catch you on the next video. Thanks for watching.